Have you ever wondered how to start investing? Welcome to the world of investment, a realm where your money works for you. The sphere of investment is not just about multiplying your wealth, but it's also about securing your financial future and realizing your financial goals. Now you might be thinking, why should I start investing? Well, the answer is quite simple. Investing enables you to grow your wealth and secure your financial future. It's the process of putting your money into financial schemes, shares, or property with the expectation of achieving a profit. Investing is especially beneficial for young individuals. Starting early gives your money more time to grow thanks to the power of compound interest. If you start investing a percentage of your income each year from a young age, you can build a substantial nest egg for your future. The world of investing might seem intimidating at first, but don't worry. We're here to guide you through a simple, 5-step plan to start investing. This plan is designed to help beginners understand the fundamental concepts of investing and take their first steps into this exciting world. If you're ready to take control of your financial future, stick around as we delve into a 5-step plan to start investing. To embark on your investment journey, first, you need to understand your investment goals. These goals are the compass guiding your financial decisions, and they are as diverse as we are as individuals. Let's take retirement, for instance. Investing with retirement in mind means prioritizing long-term growth, perhaps through a diversified portfolio of stocks and bonds. This strategy acknowledges market volatility, but trusts in overall upward trends over the years. Alternatively, you might be saving for a down payment on a house. This goal would likely warrant a more conservative approach, favoring lower-risk assets to protect your capital. After all, you wouldn't want a market downturn to wipe out your dream home's down payment. Or perhaps you aspire to launch your own business. This goal might motivate you to invest in high-risk, high-reward assets like startup equity or even cryptocurrencies, betting on the chance of substantial returns. Each goal carries its own risk tolerance, time horizon, and potential return, informing the investment strategies you adopt and the decisions you make. Now that we've established the importance of setting clear investment goals, let's move on to the next step. Choosing the right investment account is a crucial step in your investment journey. It's akin to selecting the right vessel for a voyage. A mismatch could lead to a turbulent journey or even a shipwreck. So, let's dive into the sea of investment accounts and help you find your ideal ship. First, we have retirement accounts. These are accounts designed with the long term in mind, where your end goal is to build a nest egg for your golden years. You might be familiar with the names 401k or Individual Retirement Account, IRA. The unique advantage of retirement accounts is the potential for tax benefits. In some cases, you might get a tax deduction on your contributions, and in others, your withdrawals in retirement could be tax-free. Now here's a pro tip. If your employer offers a 401k match, it's a good idea to contribute enough to earn the full match. It's essentially free money that your employer is offering you, so why not take advantage? Next, we have taxable brokerage accounts. Unlike retirement accounts, these accounts don't come with any special tax advantages. But they offer something arguably just as crucial: flexibility. With a taxable brokerage account, you're free to withdraw your money at any time without incurring penalties. This makes them a great option for investment goals that aren't retirement-related, like saving for a down payment on a house or funding a child's education. So which account should you choose? Well, it largely depends on your investment goals. If you're saving for retirement, a retirement account might be your best bet. But if you have a shorter-term goal or you want more flexibility, a taxable brokerage account could be the way to go. Remember, this decision isn't a one-time thing. As your life and goals evolve, you might find that a different type of account suits you better. So keep reevaluating your choice as you journey through the investment seas. Choosing the right account is just the beginning. Next up is understanding what to invest in. Now that you've chosen the right account, the next step is to understand what to invest in. Embarking on your investment journey opens up a world of possibilities. You've got a smorgasbord of options, from stocks and bonds to mutual funds and beyond. Let's break them down. Stocks represent a slice of ownership in a company. They can be volatile, but they also have the potential for high returns. Imagine being part of the success story of the next big tech company. Exciting, isn't it? Bonds, on the other hand, are like IOUs. When you buy a bond, you're essentially lending money to a government entity or corporation. In return, they promise to pay you back with interest after a certain period. They're generally safer than stocks but offer lower returns. Mutual funds are a basket of stocks, bonds, or other securities. They allow you to diversify, spreading your risk across many investments. Think of it as not putting all your eggs in one basket. It's a safer bet for those who prefer a hands-off approach. Diversification is a key strategy in investing. It's about spreading your investments across different asset classes and sectors. This way, if one investment performs poorly, others may perform well, balancing out your portfolio. Understanding the risk associated with each type of investment is crucial. Stocks might be riskier than bonds, but they also offer higher potential returns. Bonds are less risky, but offer lower returns. Mutual funds offer a balance, diversifying your risk. So, how do you choose? It all comes down to your risk tolerance and investment goals. If you're a thrill seeker with long-term goals, stocks might be your game. If you prefer stability and have short-term goals, bonds could be your best bet. If you want a bit of both, consider mutual funds. Understanding what to invest in is essential, but equally important is knowing how much to invest. Determining how much to invest can be a daunting task, but we're here to guide you through it. In the realm of investing, there's no one-size-fits-all answer to how much one should invest. It's a decision that hinges on your financial circumstances, goals, and risk tolerance. That said, there are a few strategies that can help guide your decision. One common approach is to invest a percentage of your income. The actual percentage can vary substantially based on your financial situation and goals. However, a common rule of thumb is to aim for at least 10 to 15%. This includes your contributions to retirement accounts. This way, as your income grows, so does your investment, ensuring you're always investing in line with your means. Alternatively, you may prefer to set a fixed monthly investment budget. This method is particularly useful if you have a tight budget or a fluctuating income. By setting aside a fixed amount each month, you can ensure you're consistently investing while also maintaining control over your finances. Now, let's delve into the concept of dollar-cost averaging. This is a strategy where you invest a fixed amount of money at regular intervals, regardless of the price of the investment. The advantage of this approach is that it mitigates the risk of investing a large amount in a single investment at the wrong time. By spreading out your investments, you buy more shares when prices are low and fewer when they're high, potentially lowering the average cost per share over time. Remember, these strategies are not mutually exclusive. You can invest a percentage of your income and also use dollar-cost averaging. The key is to find a strategy that works for your personal circumstances and stick to it. Now that we've covered how much to invest, let's wrap up with the final step. The final step in your investment journey is to regularly review and adjust your investments. This step is crucial because it ensures that your investments stay aligned with your financial goals. You see, the world of finance is not static. It's a dynamic, ever-changing landscape, and your investments need to reflect that. Your investments are like a garden. You can't just plant the seeds and walk away. You need to tend to them, water them, give them the right amount of sunlight. Similarly, your investments need your attention. They need to be nurtured, reviewed, and adjusted according to the conditions of the market. Why is this important? Well, let's say you've invested heavily in a certain sector, and then the market conditions change. That sector might not be as profitable as it once was, and if you're not paying attention, your financial goals could be at risk. That's why it's important to stay informed about the market trends and keep an eye on your investments. Don't be afraid to make adjustments. It's not about timing the market, it's about time in the market. And remember, investment is a marathon, not a sprint. With these 5 steps, you now have a roadmap to start your investment journey in 2024.